Employee benefits. So I sent the notes, and I hope everyone has submitted the notes. So I want us to go through the notes in your view. Chapter in the notes. We can discuss all the notes to find at least 2 questions, at least. So the objective of IAS 19 is to prescribe the accounting and the disclosure for employee benefits, requiring an entity to recognize liability where an employee has provided services, and to recognize an expense where the entity consumes the economic benefits from an employee's services. Examples of employee benefits, we have salaries and wages, post-employment, medical and life insurance benefits, jubilee benefits. Jubilee benefits are what kind of benefits? I'm not sure about the benefits which you are given when you have worked for an organization until you have turned 50 years of age. Not that you have worked for the company for 50 years, but you have clocked 50 years when you are in that organization. Though inaonekana siasa, kuna mtu amekuja Januari na akafika 50 na anataka kupewa hizo benefits. So wengine wanasema sisi tumekaa hapa from 2010 mpaka leo, you hajafika 50, inakuwa mpaka ufike 50 years. So jubilee benefits, termination benefits, profit sharing, and bonuses. The above benefits may be categorized into 2. There are those which are short-term, and there is post-employment. The short-term benefits are those benefits which are expected to be settled before 12 months after the end of the annual reporting period, during which employee services were rendered, excluding termination benefits. So the benefits payable within 12 months period, those are called, those are short-term benefits. Then we have post-employment benefits. These are benefits attributable to an employee upon retirement. The entity may have formal or informal post-employment for its employees, no problem. So we have 2 types of post-employment benefits. There is defined contribution plan, and there is a defined benefit plan. So defined contribution is a benefit plan in which the entity pays a fixed contribution. However, the amount receivable in form of benefits is not fixed. Instead, it will depend on the performance of the fund investments, e.g. NSSF. NSSF, what you are contributing is known. But when you make a list, at kila month we cut off for the years you have worked, then when you retire, you go to NSSF, you tell them, bring my statement to see whether they match with my records. Then you expect to get the same. Can it apply? In fact, most cases, I don't know what I want. Yes, so, but what you contribute is fixed. But the amount you will receive is not that what? It's not fixed. That is a defined contribution plan.
How much do you receive?
How much do you receive? Yes, I know some commission. The performance of the investment. Yes. Walitumia pesa yako kujenga. Sasa siku wako na manyumba kila mahali. Hapa down. So how was the performance? Was your money serious in terms of investment?
So can you say you can receive more?
Yes. 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 In fact, most places people receive more. But kuna legislation yenye inaletwa, they are integrating with KRA. Actually, they are already integrated. What they are trying to do, hata wameshaanza kufanya tax compliance. So ukienda kuchukua requirement, unaambiwa give us compliance, and you know what you have been doing. So unaenda KRA wanakuambia from our records, tunaona kuna nyumba uko nayo Eldoret. Na hii nyumba iko na mita. Kuna mita ina run, na hii mita imekuwa ikirun for the last 15 years. Na si mita moja, there are 14 meters under your name. So we sema kuna 14 houses. These are rentals. So you have rental to declare, and we have the total interest and penalties are coming to 674,000. So can you settle this 674? Then you go to NSSF, you get your 500,000. So which one do you go for? Maybe I want to go your friend that you are there.
No, kingoja mpaka wapeane ile riba.
At the county governments, what you need to do is to know county governments do not give waiver on rentals. They only give waiver on land rates. Yeah, rental KRA. So about what they have come up with now is what we call the voluntary disclosure, where you go and say nilikosea lakini naomba msamaha. Alafu nakwambia sasa wote tukusamehe kidogo but you have to pay something. So make sure you are tax compliant so that NSSF will not catch up with you upon retirement. I don't want to go into many stories, but where I stand, I'm sure not all of us are paying equal amounts of NSSF. What do I come to Sangha? Yeah, kwenye anafanya kazi anakatwa 1080, hata mimi nakatwa 1080, 200. Ama wewe gari yake bora tu imeingia. No. Even 200, there are so many people. Online sioni mtu aniongelesha ama nyinyi ndio mnakata watu. Or you are the employers. There was a legislation, Prudence asema yana katongwa 200. Still is okay, but hapa Milimani Law Courts, there was a case that employer is supposed to contribute 6% of the gross salary, and employee also to be deducted 6%. So it was to come, 6. Hiyo inakujanga taya 1 taya visual. So ikakataliwa, ikatuliwa the pioneers. Ikakataliwa bado imelala hapo. So because Kenyans wanatukanga wakisikia ati NSSF sasa watu wanafaa contribute hivi. Wale wanaogopa walianza immediately. Na wakaanza kusema na ikipitishwa nyinyi mta backdate. But when individual ngumu wakasema the law is not applied retrospectively. It will take effect from that date. So we are taking stress mingi bado wanakatanga 200. But if I'm the accountant, I will go for the highest, the 1080. Because 1080 times 2 comes to 2160. So saving for me 2160 is better. And also, you know, NSSF is also one way of the tax planning, among the tax planning. It reduces what? Pay. So yes, it will reduce your pay. So if you are, wewe unaona unakatwa kidogo so unafurahia kwa ile side nyingine na tax umeumwa ile side nyingine.
Kwa Elias asikatutegemea wakati contribution yako.
So that is your money. So Prudence just advise them to be contributing as per tier 1 and tier 2. 6% employer, though you know max that one. You can even go for voluntary contribution. Still, the voluntary will reduce your pay. So instead of giving the money, kukuja ama campaign, so that is defined contribution. What you are contributing, you know. What you will get only Jesus and God knows where they are. Hakuna mtu anajua. Wewe unakaa tu ukitaka. If you ukitaka you are going to bed. Hivyo unasema ati ni pesa yako. Then you go and get them hapo kwa hiyo. What do you want? There is nothing like customer service. What do you want? Retire. Tax compliance. Next. Number 2, but you can get your retirement benefits before the age. I hope you're aware. Today, retirement age is 60, but they are saying at 50 you can get your benefits. But on one condition, don't appear in anyone's payroll again. Yes. once they have given you now the retirement, nobody should contribute for you again. So if there is another contribution, it will bring problems. What a terminator So once you click 50 and you feel you want to retire, fine. Then your pension. Defined benefit plan is a form of post-employment benefit plan other than a defined contribution plan. Amount contributable may not be fixed. However, the amount receivable is fixed in advance. Mostly in the insurance companies. If you contribute 700,000 by the end of the year 2066, we'll give you 2 million. So the amount, they don't tell you how much, what you are contributing is not fixed. So we will be paying. We make sure by the year 2066, you have contributed that amount. Don't like NSSF is a must buy or before 9th, excuse me, 9th, say 15th. Yes, by 9th, we will contribute that amount. So this one is not fixed. But what you will receive is what you people determine in advance. I don't get insurance, that's all the parade. When if you contribute this, you will be able to get this amount plus bonus at the end of.
What if you notice the amount?
So the best examiner can ask you them, which I know is there, just to explain the two types of post-employment benefit plans. In section 3FR, there's a day they were asked, why would someone prefer a defined contribution instead of a defined benefit? Of course, one of the answers is for planning purposes. You know, when you know what you are contributing, you can plan. Then for portability. Portability means in a defined contribution, you can work for who you employ, and the SSF doesn't expire. You move with it to another employer. But this other one is very difficult because it's a agreement between you employer and your insurance. Yes, so this one can bring problems. They can even terminate. So mostly for planning and the movability or portability of the policy. NB, when accounting for defined benefits plan, various actuarial assumptions must be taken into consideration. So actuarial assumptions, when we talk of actuarial assumptions here, remember, someone is telling you, when you contribute this is what you'll be able to get. Those who normally come up with those figures are called actuaries. Actuaries are the people who normally carry out the scheme valuation. So when we talk of actuarial assumption, are just the projected figures by the actuaries. So when they are making those assumptions, when accounting for defined benefits, there are some actuarial assumptions which must be taken into account or into consideration. They include, there are only one final assumptions. This consists of interest to be charged on pension, future expected salaries and benefit levels, future medical costs, expected rate of return on plan asset. Plan asset is the investment you have in the scheme. If you have a scheme, the way you ask whether you can get more, yes, you expected return on what you have invested. When the economy is doing well, like right now, I know they are really taking advantage. You end up with a pesa yako ni kidogo. Ukikompare na kusema wewe huko nje kwenu, unaona economy ikiwa hadi. But there's a time you can feel the economy is better. Yes, so when the economy is performing poorly, don't expect much returns. I know some of us here are investors in money markets. So you know when the economy is worse, the rate of returns and the rest. Then there is demographic assumptions. This deals with the matters such as mortality rates during and after employment. Then rates of employees turnover, disability, and early retirements. Then there's something we call multi-employer. That is just by the way there. Multi-employer plan. This is where different entities contribute to different pension plans for the benefit of their employees. So napata your employer kuna retirement scheme with Britam, kuna Jubilee, kuna CIC. So when the employer is contributing for you, with different schemes, then that is called multi-employer plans. Accounting for defined benefit plan. How do we account for them? You know, for contribution, I issue. What you are contributing, you know. But this other is where the problem is. Because you know it is projected in advance. And you will always want to see what will be. Will I get the same? Because you can make your estimate based on what you expected. Not only to be disappointed. Ile disappointed in about hapo. Wacha niwape story. Kuna siku nilienda hii sako ya accountants. Inaitwa Mwasimu. So I wanted a loan facility. And in that loan, one of the guarantors, if you have life insurance policy, then that life insurance policy can act as your guarantor. So instead of telling people, oh, come and guarantee me, Mwasimu will allow you to use your insurance as a guarantor. That you will contribute. Because this is very fine. So, no, I'm not ashamed of disclosing the figure. I contributed up something around 180 in that insurance. So nikasema hii 180 ikikava hii, at least tasumbuka sana na watu. One by one nikamwambia simulipe hiyo barua nipeleke huko. Ikawa akaniambia we have no problem. What hesabu ifanywe? Out of this, the amount which I could use to guarantee that loan was only 27 and some hundreds. Nikauliza how? That it is only based on the surrender value, not the entire amount. You don't use the entire amount. Surrender value. So you surrender value kafanywa na hesabu zingine. What? So, and that is how it behaves. So nikawauliza na simuliambia inaweza. Wakaniambia yes, it is possible, but it is based on it's based on the surrender value, not on the entire premiums you contributing. That is Kenya for you. Na ni wakali, si ati wewe peke yako uko. So this post-employment, they are very the defined benefit, they are very tricky, and they are always observed by the government and even this other contribution. Because if they are not observed, so how do we account for them anyway? IAS 19 requires that an entity should recognize both plan asset and plan liabilities in relation to a defined benefits plan. In case the plan asset, and I want this thing which you literally on face value. When we talk of plan is the scheme. Scheme is the fund. What is the insurance? That is what we are calling the plan. Asset is the amount we have done what? Contributed. Now, there's something that is true. Ukiwa na pesa kwa insurance, umesave, hata ukumbukaji. Lakini ukiwa na pesa kwa account, you always remember what that money. Ukiwa na 200,000 tuseme Equity Bank, inazungua. Mwingine ananiambia hata anapitaka hapo karibu ile bank aone kama kuna polisi hapo. Hapo hiyo. But this other one doesn't. So what you have saved in that insurance, that is your plan what? Asset. So the standard report, they tell you to explain how this should be accounted for the books. In case the plan assets exceed the plan obligations, which is liabilities, then an entity should recognize what? A surplus. And the plan asset in the statement of financial position. So if the assets are more than the liabilities, then the net position is an asset. Then you recognize surplus, which is the difference between the assets and what? Liabilities. Similarly, an entity should recognize the following components. So there are some components which should go to the books: service cost component, interest cost component, and remeasurement component. So we need to check them one by one. What is service cost component? This includes the current service cost and past service cost, together with any gain or loss on settlement or curtailment. Current service cost is the increase in the present value of the defined benefit liability resulting from employee services in the current period. Hizo ni vitu mingi. Current service cost is the cost the employer incurs to service the scheme during the current what period. Lazima uikae expense kama hata withdraw check. Hii country iko na expenses mingi. Do you know hiyo wanasema wacha hiyo watu wanalia ati ukitaka kutafuta kazi sijui you must clear with. Tuna clear na kina nani? Hell na C3. Other students ukienda campus who apply even through the government, so you have to pay. Ile portal yao inaitwa KUCCPS. So you have to pay for it. And this is how we kutoka high school, and you have to pay for you to apply. So even here, for you to maintain a scheme, you must incur costs, a must. So the cost which was incurred by the employer to maintain the scheme in the current period, those are called the current service what? Cost. So it increases the liability, the obligation of the scheme. Then past service cost, on the other hand, is the change in the present value of a defined benefit obligation for employee services in the prior periods. So we always have an issue here with past service cost when it comes to now accounting. Past service cost, let me explain. There are those people who joined this company in 2010. There are those people who have just joined in 2021. You joined the company when the company was starting. When every morning ukikuja unaambiwa let's have a word of prayer for this company. Mnakuja mnaomba. Sinakwanga hivyo. Ikisha grow yenye mkubwa anakujanga na gazeti. Kazi yake ni kutukana watu, ndio incompetent. Ndio anasema now we want to define a contribution. We want people to have pension. So a good employer will say those people who joined in 2021, let's kick off from now. Those people who have been there from 2010, let us backdate. We contribute for you as if it started by that time. So the cost that the employer will incur to backdate for those people who were there prior to the commencement of the scheme, those are called past service costs. And the past service cost, you don't adjust the books backwards. It should be expensed in the current year. So that's the only problem you have with students. You don't, some of them just leave it. We're going to pass service cost 1 million. Wanasema sio ya past. Na sasa tunatengeneza 2022 lesson. No. You expense it in the current financial period because the scheme just commenced right now. So you backdate for them, but the cost you incur, you come and expense in the current period. Then we have curtailment. Curtailment occurs where there is a significant reduction in the number of employees covered by the plan. So when some people have, maybe there are some employees who died, some have left, some have retired. So you go and renegotiate. You renegotiate the terms of the scheme. That is called curtailment. Settlement occurs when an entity enters into an agreement to eliminate the obligation by paying the retirement benefits. Those are not very important. What is very important? The first two, the current service cost and the past service cost, both in definition and treatment. All of them are expensed in the books. So that is one component which should be recognized. Then number two, there is the interest cost component. This relates to the changes in measurement of both plan obligation and plan assets arising from the passage of time, computed by applying the discount rate for the plan obligations and the expected rate of return on plan assets at the beginning of each financial year. Interest cost component is an expense to the employer, while the expected rate of return is recognized as what? Income. For the contribution you have in the scheme, tunapewa interest on top. But if you have failed to service the scheme, uko na madeni huko, hiyo deni pia inachaliwa nini? Interest. So interest on the obligation we expense, while interest on the assets we treat as expected return, which we recognize as income. Then we have what is called remeasurement component. This comprises the actuarial gains or actuarial losses arising during the financial period. Actuarial gain or losses is the increase or decrease in the net pension asset or liabilities that arises due to changes in actuarial assumptions, due to the differences between the previous actuarial assumption and the actual outcome in the scheme. So actually, the way we say, they normally project. Speak about Mwekwa na what insurance wanakwambia. They ask a lot of questions. What is your age? What? So many stories. Alafu kimwambia yote anakwambia, so wewe unaweza contribute na utapata hii. So they predetermine in advance. So they actually have predetermined that after the end of whichever year, you will be able to get this much. On that day, they tell you now what you are supposed to get is how much? 60. So the difference, so the projected amount is what we are calling the actuarial what? Assumption. Then now this one is the actual outcome. So what the examiner will do, examiner will give you the actual. Then you project. So you work it as if you are the actuary. So you do the projection, then you compare the projected amount versus the actual what? Outcome. The difference between the projected amount and the actual is either actuarial gain or actuarial loss. By so doing, you are carrying out what is called remeasurement. You are remeasuring because initially you are projected, but now you are checking it against the actual outcome. Actuarial gain or losses are to be recognized in other comprehensive income during the financial period. We don't take them to profit account because it is not a normal business activity. You are unapata mna share, in some company we share. For your pension, meaning kato kidogo, employer atole kidogo. So any income from there you don't recognize fully. Elements of remeasurement components. Can you check for me May 2021? Open the paper. May 2021, question 5C. May 2021, question 5C. May 2021, question 5C. Nani amepata tusome? Yako inakaa FM. You from the looks. Ikai inakaa leo. I can see from abroad. Nani amepata hiyo swali? The elements of measurement components. Angalia kwa kama hiyo next. So the components of remeasurement components, which ones did you write? We have actuarial gains and losses, because when you do the reassessment capacity, then we have return on plan assets, then any changes that affect the plan assets excluding interest components. Then we will kusoma hiyo swali Jason.
Describe the elements of the remeasurement components.
components of the net defined benefit liability assets. Indicate how the treatment of the measurement component and the Ipsos compares with that of commercial sector entities
IS
17.
Yes. So government, as you know, they use IPSAS. So how does the gain or loss, how do we recognize them in the books of the government? And how do we recognize them for the private commercial entities? So for the commercial, the way we have been saying, for commercial, you take them to other comprehensive. Those are also recognized as part of other comprehensive. But now government law not use of other comprehensive. So what they do, they recognize it straight to fund account, which fund account here quotes is the equity. Yes, that is what happens. So you read here and say, yes. According to IPSAS 39, the remeasurement component, however, wauliza tena. But this custom school of Itabo, we used to backdate questions. Kama sahi in 2022, narudi kuna swali ya 2010, 2011. But siku hizi, hiyo swali ya jana, hiyo yenye unaona kuna Kiswahili tulikuwa tunasemanga udadie kumbe si ndiye. Ilikuwa kama nikumbuka. Yes, the one you are thinking is not is the so now is the bring the very current. So I see maajabu kuulizwa tena. According to IPSAS 39, the retirement component gains or losses should be recognized to equity and should not be classified to surplus or deficit in the current and subsequent periods. Ikishawekwa huko kwa accumulated funds, hiyo itakuwa current, which will say retained earnings in quotes. Itakuwa to brought down hivyo. So you don't take it to surplus for the year or deficit for the year. Unaitake huko kwa accumulated fund account. But under IAS 19 requires that the measurement component, the gain or loss, should be recognized as other comprehensive income during the financial period under consideration. In case waulize. Note, defined benefit plan should always be measured at fair value, while defined benefit liability should be measured at their present value. Because liabilities should always be measured at present value because they are future. But assets, because it's current, you check the market what? The market value. Let's go to December 2017, question 2C. So get out your past papers. Financial reporting, what is the next question? Get out the past papers. 17, check December 2017. December 2017. So let's hit there right now.
Yangu.
So hii yako kwa 78 na May. People are back at the back. Yeah. Comfort. This one is comfort. If my paper is not properly arranged, so it is. Yeah, to do it again, which one? I think it is after 2018. Question 5. 2C, I got it. All right, so let's read that question. Question 2C. December 2017. Question 2C. It says, the following information was extracted from the books of Comfort Retirement Benefit Scheme for the year ended 31st of October 2016 and 31st October 2017. Discount rate on 1st November. Discount rate is the interest charge for the interest charge on liabilities. They call it discount because liabilities remember discount present value because they are paid in future. So the discount rate is for the liabilities. Expected rate of return, as you guys can see, average remaining service life. Usifikiri hiyo average remaining service life ndio ati mtu atakufa, hapana. Average remaining service life is the period the employee will still remain active in the scheme before retirement. Fair value of plan assets, present value of plan obligation, current service cost, benefits paid, contributions to the scheme. Hapa kuna past service cost, eh?
Yes.
Okay. As at 1st of November 2015, the present value of plan obligation and the fair value of plan asset were both 100 million. So that is at the beginning. See 2016, 2017. So 2015 was the opening. So when we opened the year, both obligation and assets were standing at 100 million. Assume all transactions occurred at the end of the year. So this are required for each of the years to 2016, 2017, determine the actuarial gain or losses, the net pension cost to be charged in the income statement, balances to be reflected in the statement of financial position. I assure you, all those things are the same. These ones for the pension are almost similar. So once you understand this one properly, those are but just a small adjustment. So let's kick off. For you to get here it is. They are saying the actuarial gains or losses. No, gains or losses. Whenever you are operating a scheme, two things. You will have an investment and also you have obligation to service the scheme. So you need to determine actuarial gain on the obligation and also actuarial gain or loss on the assets or investment. So you determine for both the assets and obligations. Then you will have answered it perfectly. So let's start with, we said we start with obligations. So let's start with obligations. You can start with whichever makes you happy. So actuarial gain stroke loss on plan obligation. Actuarial gain stroke loss on plan obligation. Shillings and millions. Sorry. There are 2 years. So the 2 years we must present them together. 2016, 2017. Shillings and millions. So you have to get the gain or loss for each. You must get the gain or loss for each. So you start by saying present value of plan obligation brought down. How much? How much is the present value of the plan obligation brought down? 100, correct. So this is 100. Then what I if you don't pay, now this is the projection we want to do. If you don't pay, we'll charge you interest. So interest charge, they are charging us 10%, 8%, the discount rate. Yes, the discount rate is always based on the opening value. So 10% of 100, that is how much? 10. Then current service costs, you will have to incur during this year to maintain the scheme. So current service costs, you can even post across. How much is the current service cost? 8 and 10. So this one just bring 8, 10. 8, 10. Then when you are, then there is past. There was past service cost, but it was only 2016. 4, not there. Yes. Then when you are paid benefits, when benefits have been paid, you reduce. You reduce the obligation because obligation is assessed based on your investment, which you agree with me. Anybody who has been paid, mwenye akona kwa account yake akona 1 billion. Ledger fee ya mtu akona 1 billion the same na mtu akona 80 shillings kwa account. They are not the same. So obligation is assessed based on the investment. So when you are paid investment, you are paid benefits. Actually, the double entry is credit the investment account to reduce your investment, also debit the obligation. So they argue that obligation reduces proportionately or changes proportionately with the change in the benefits paid. So benefits you let off in both. Yes, so you let it here also on the investment, which is assets. So benefits paid. How much is this? 15 and 12. 15 and 12. Only is now one is correct. And most for past service cost is very rare. So what you get here is what we call actuarial what? Assumption. This is the actuarial assumption. So we can only get 2016 because this one is not complete. So how much? 107. So the actually, if we go as per the things he has said, actual outcome in the scheme should be 107. Skip 2 lines, 1, 2. Skip 2 lines. Then you check present value of plan obligation, carried down. You prepare an examiner vizuri. That one they will not deny you. So check the actual outcome in the scheme. How much? At the end of 2016. Present value of plan obligation 1st November 2016. Are you seeing it? Are you seeing the 100? So the actual outcome in the scheme, 100. So the projected value was 107. Actual outcome, 100. The balancing figure Now, hapo tunafanya what we call remeasurement. So upon remeasurement, you will report actuarial, either it will be a gain or it will be what? A loss. So can you tell me, we have lost, we have gained? We have gained. So because the obligation has gone down. Umesikia Kasnet mtihani ni 107, ukabeba 107. Ukifika unaambiwa ni 100. Watu hivi nalikuwa nikaona issue. Kama ni day class wapate hivi, hata wanapiga simu tena imeongezwa. The fees is half. So this is again. So utilize that gain to reduce the obligation. So the gain should reduce obligation. Then the closing here becomes the opening in the subsequent period. So this 100 is what you bring here. So 100, 8%. 8% of that comes to 8. So the actuarial assumption $106. So give us that 106. Actual outcome in the scheme 125. We have gained, we have lost. We have lost. The obligation has gone up. So we have lost by how much? 19. Hiyo unaongeza hapo kwa obligation. So we have determined actuarial gain loss on plan obligation and you get 1 mark. Let's go to assets. Hii unakimbiza mbio kwa mtihani. So let's go to assets. There being no question from honorable members. So let's do for assets the same. So actuarial gain or loss on plan asset. Actuarial gains or loss on plan asset. (2016, 2017). Shillings are in millions. We kick off? Yes. Yes, kick off. So fair value, assets are measured on fair value of plan assets brought down. So fair value of plan assets brought down. So I saw both what 100. So 100, give us there. Wanakwambia ukiwa na hiyo asset tutakupatia returns, ndio? But can I start saving your time? What is the closing 2016? Because you utapewa the actual outcome 2016 for the fair value assets. There's a way I want to save your time. Ningapi? Closing 2016. Closing 2016. Fair value 1st November 2016. Is it 96?
Yeah, 96.
Not 96. I hope I'm not trying to make your work easier. 96. So back in your mind, you know, closing in 2016 will be the opening in 2017, right? Yes. So right up here 96. Sure. Expected returns expected returns, percentages, 12 and 10. Sure. Expected rate of return, 12 and 10. So 12% of 100 is 12, 10% of 96 is 9.6. Then contributions you make in the scheme, the contributions you make increases your investment. So contributions you add. So contributions, how much? 911. Benefits will reduce. So benefits paid 1512. Question. Actuarial assumption. Nani hapo na the second one or first?
106.
The first one. 106. How about the second? 104.6. Of course, we know balancing figure will either be actuarial gain or loss. It will be actuarial gain or loss. So fair value of plan assets carried down. Of course, we have been given 2016, 96. Here again, 110. So tell me whether we gained or we lost. The first one I'm told we gained, that is, no, you're right. We lost because in the asset. So we lost how much? 10.
Yes.
We lost 10. This one we gained, the second one. We gained how much? 5.4. Correct. Then now, what the standard requires, what the standard requires, in the same scheme, on the obligations, we gained, we lost. We lost, we gained. Get for us the net position. So net actuarial gain stroke what? Loss. Net actuarial gain stroke loss 2016, 2017. Shillings are in millions. So what? So for obligations, you say here again, stroke loss on plan obligation. Then gain stroke loss on plan assets. Like that. So on obligation 2016 we gained. We gained 7. We lost how much? 19. For assets, here we lost 10. We gained 5.4. So the net remains a loss. The net is a loss. So here the net is a loss of how much? 3. On the other side. The 13.6. The marks allocated to that thing is not worth, but I think they think it is easy. So, alright, let's go to Roman 2 of the question. So, oh, go online. Yeah, nakuza sawa nimecheti kama ni negative. Thank you. Is that us? Alright, so camera. Let's go to Roman 2. Roman 2, what do they want? Net pension costs. So net pension costs. Net pension costs. So net pension costs, you just check the expenses which should go to P&L for each year. Actually, the one, are you seeing the current service cost? Yeah, that's a pension cost. Current service cost. Look for them. 810. Current service costs. So tukimaliza hii swali, I will end the class. I'm supposed to be like keep here by around 12 Nanyuki that. Yes, today. So I will have to end it tukimaliza hii swali. Then I'll pay assignment. Alafu mkirudi next class ati. I'm not sakuna. Yes, I'm going to assignment exam. So we have to do 1, 2, 3, 4. So you have to do 4 questions. So this is just the first one. So there you go. Then interest. Interest charge. So interest charge, check obligations. Check obligations. There is an issue. Roman 1, 2 marks. Correct. Yes, need to be a base. By the time we don't understand what is this. Right? So we'll find out within seconds. Interest charge on your obligations was 10. Or 8 and 10, 10 and 8. Okay. Past service cost will also be charged in the current year. Past service cost 4. Then the actuarial, this one comprehensive. There is expected return. Expected return. So expected return, check here. The examiner what the net pension cost. So all these 1, 2, 3, 1, 2, 3, these are costs. But expected return is an income. So utilize this income to reduce the expenses. Sure. So the returns here is 12. All these are expenses. I'm going to require Roman 2. The net pension cost. You know, cost is the expense. This is an expense, but this is an income. So use this income to offset the expenses. So again, utilize how much? 9.6. So how much is the cost? How much is the cost? 10, 8.4. Then other comprehensive income, OCI, other comprehensive income. So back in our mind, we know this 10, the 8.4, those are expenses. So, then there was net actuarial gain or loss. All of them were losses. The net. So the net, there was a loss of 3. So loss you just add as part of the expenses. And this one was also 13.6. So total comprehensive 13. This one I think is 22. So those are the net pension costs. So net pension costs, as you can see. Next, they want us to get what? Financial position. So balances, the capital balances to SFP, statement of financial position. You are the easiest. When do you prepare balance sheet? At the end or at the beginning? At the end. So take the present value of plan obligation, current down, and fair value of plan asset, current down. All those ones we have. So present value 100, 125. This other one 96, 110. So if you check keenly, the obligations are in each case are more than the assets. So use the assets to reduce your obligations. So net pension liability, it will be a liability. Net pension liability for 15. Net pension liability is 15. Good. I must caution people in advance because this topic has a sister topic known as share-based. In exam, from the time memorial, either all of them are present or at least one. At least one must be there. Share-based and this one. So I've checked the paper last semester, I've seen they got this one here. So don't work with that assumption now. They can still bring all of them. Mesema, they alternate, share-based or this one or both of them. So to be safe, you have to know those two topics. So far, this one you are getting well still. So I want you to check for me this sitting. I can see it is like 2 minutes to 8. And I know people are preparing for Real, the Liverpool. So me, I'm traveling overnight. So check for me this question here. May 2019. May 2019. May 2019, question 3. Question 3A, Roman 2. Question 3A, Roman 2. I know that question, even before you open, that question, there will be a problem because the rate which was provided was 1. And even they are sitting in one rate. One rate for interest. Not about interest, charge could require different rates, 10 and 8. So for this one, the rate is just 5%. So where you have been given the interest charge of where interest charge and expected return to be the same, no interest charge be the same, then you apply it both on obligation and what? Assets. That is the only issue with that question. So where you have 2 rates, one rate, then it cuts across on obligation and assets. You can attempt, then we do in the next class. So tutafanya hiyo, na tufanye hiyo ya last city, then tuta-advance kidogo. There is part of it tuta-advance kidogo. So thank you so much. We are moving on well, because as you can confirm, tuko na day at par, evening tunawasha kidogo. So evening mostly tunatumianga kama benchmark, so we are not part of. Then I'm afraid again, this class, this evening class, need to direct. This one will continue until the end, unless something comes up. But I'm seeing possibility of Sunday again coming up, whereby you'll be combined with evening. Your syllabus, so prepare for 100 times ahead for the remaining 8 weeks. Yeah, the remaining 8 weeks. Let's just try to adjust. Even me, I'm trying to finish this safaris. So that we focus. Thank you. Do have a good night. We'll meet next week. God willing. Watu online, salimia watu nyumbani.